Hi, everyone. Welcome to another episode of Bits and Bips, the interview, the show where we explore crypto and macro colliding one basis point at a time. My name is Steve Ehrlich. I am the head of research at SharpLink and also your host. We've got a tremendous show for you today, but before we dive in, let's take a brief moment to hear from some of the sponsors who make this show possible.
Bitcoin changed how money works. Citrea changes how Bitcoin scales. With a trust-minimized BTC and a native stablecoin, ctUSD, Citrea enables Bitcoin capital markets with lending, privacy, Bitcoin yield, and more. Get started at citrea.xyz/unchained. MultiChain Advisors is an emerging technology growth firm that has helped create $50+ billion in enterprise value for 80+ clients over the past 4 years. They're the partner to help navigate markets. Build real traction today at multichainadv.com. If you've been loving Bits and Bips, don't forget that the show is transitioning to its own feeds on X, YouTube, and your favorite podcast player. If you're not already subscribed to Bits and Bips on its own channels, go there now and hit that subscribe button so you can keep up with our twice-weekly live streams and Macro Meets Crypto breakdowns. Bits and Bips will only be on the Unchained feed for a few more weeks, so subscribe today to be ready for launch. You can get all the links at unchainedcrypto.com/bitsandbips.
All right, welcome back. Just one more bit of homework before we begin. As always, nothing that you say or hear or nothing that you see or hear on this program is meant to be financial or investment advice. Please see unchainedcrypto.com/bits and bips for more information. And with all that said, I'm delighted to bring in my guest for today, Josh Lim, someone who is, I believe, a repeat guest, although the first time on my one-on-one show. He is FalconX's global co-head of markets. I can't talk today. Josh, really great to see you again. Welcome back.
Yeah, thanks for having me. I know my title's a little bit of a mouthful.
Not your fault. For some reason, I'm having some trouble speaking today. Anyway, so I'm going to ask you questions. A lot going on in the markets. I mean, you see this every day when you're watching what's happening at FalconX. I mean, one of the biggest, if not the biggest, prime brokers in crypto. And as I was trying to kind of prepare the show, I myself am trying to make sense of what's going on. I mean, we saw some of the big indices set new records again yesterday, but the war in Iran is not over. Even Secretary of Defense Pete Hegseth was talking about how the country is ready to start firing again if, I guess, an anticipated 2-week delay doesn't continue or isn't, I guess, effectuated and negotiated. I've had guests on the show in the past few weeks, and I know you've seen it too, saying that even if the war is finalized today, the damage to energy markets will take years to recover, which will lead to issues down the line. But equities, again, are at all-time highs. But that's not the whole picture that we're seeing. Gold still remains elevated above $4,800 an ounce. And most like long-term yields, they're sort of staying where they are. They're not moving up. They're not moving down. And that kind of paints a picture to me of a market that has not figured out what's going to happen next. Would really love to get your thoughts on that.
Yeah, absolutely. And, like all of us actively trading this type of market environment, it's difficult you just have to be glued to headlines. You kind of have to be constantly reacting to things that are going on in DC and, on the ground, obviously in the Middle East. I think there's a bunch of countervailing effects, right, that are affecting Bitcoin price. And some of them are specific to Bitcoin and crypto, and others are related to the global kind of macro asset class, just broadly, all of the asset classes that people can trade in a macro portfolio. I think if we kind of step back and look at the start of the war, a couple months ago, basically you had inflows back into Bitcoin and into crypto specifically because of, I would say, largely short covering, right? You had a lot of macro funds that had shed a lot of crypto exposures and maybe even run a bit short relative to other risk assets, also even relative to gold. And you also had a bunch of early adopters of crypto who had sold, above 100K. And so generally speaking, not many of the traditional kind of long-term holder base of crypto was, I would say, over allocated into the asset class. And the war kind of changed that and flipped it on its head, right? Like a lot of people had to degross and cover positions. And then you saw like very dramatic moves in things that were in TradFi sort of proxies for crypto, right? Things like Circle stock. Now, there were other things that were driving that, of course, like the advancement in the Clarity Act. You also had changes in posture from different political and government organizations around stablecoin yield and things like that. But I think the fact remains, like a lot of it was driven by sort of repositioning of macro and sort of equity portfolios in response to the war. So what have we seen since, right? I think since then, we've seen a couple things. There's going into April, there's a definite seasonality effect where a lot of retail capital becomes available. A lot of this comes in the form of tax refunds. You generally see some positive inflows into risk assets. And I think you've seen some of the charts of just how much the differences are between this year and previous years in terms of tax refunds, and there is definitely like a bit of an excess versus historical this year.
Mm-hmm.
I think you see that kind of flow through in a couple of sectors, right? You see that in altcoins. You see some altcoin names that have been sort of persistent, high popularity and sentiment on Twitter names, things like Venice and Monad and Zcash. Those are some of the names that have really outperformed in the last couple of weeks. Some of these names are 50 to 100% off their lows of the cycle. And then you also see just Bitcoin, right? Find and establish a pretty good floor from the low 60s and now trading back into the mid 70s. The one surprising thing, which is actually a very strong indicator in my view of the resiliency of Bitcoin and the amount of latent demand in Bitcoin, is post the quantum papers that came out. So these came out sort of late March from Google and Caltech, basically describing an order or two of magnitude improvement in the amount of qubits required to effectively crack the elliptic curve cryptography of Bitcoin. And what we saw was a brief sell-off, like very, very brief blip, but generally speaking, it was an entry point for a lot of people to buy more Bitcoin. That coupled with what we know is just a long-term, well, we think long-term secular factor of Michael Saylor and the stretch preferred stock being used to fund new Bitcoin purchases for the balance sheet of MicroStrategy. Those are really the main drivers in the last couple of weeks that have kind of driven Bitcoin to recover off the lows. Like you said, Bitcoin still has a long way relative to equities, right?
Mm-hmm.
And other risk assets, which are effectively have erased their pre-war or their sort of post-war inception losses. But I do think that, it's a matter of time before Bitcoin, and it's true that some altcoins have already caught up. Bitcoin catches up as well.
Yeah, a lot to digest there. So let's just stick on Bitcoin for now. As we're talking, I haven't checked the price in the last hour or so, but I'm guessing it's somewhere around 75,000 in that range. Obviously, it's a big climb up, and it's encouraging to a lot of Bitcoin advocates that had really kind of latched onto the asset, sort of finally fulfilling its, its mandate or its or sort of, like its expectation of being a store of value asset. But we are hitting, I guess, what seems like a big sell wall. I mean, if you look at order books, there's huge sell orders. Also, if you look at some advanced analytics, like those offered by companies such as Glassnode, that $76,000, $75,000 range seems to be an entry point for a lot of people that bought into Bitcoin in the last cycle, which also suggests that there could be an opportunity for some of them to say, you know what, I'm back to par, time to get out. So, I mean, what are you seeing? And you mentioned how let's just stop there. What are you seeing right now?
Yeah, I think you're right. Like there is certainly a lot of overhang. It's not just from some of this transition from retail holders that are break even. There is a whole cohort of people obviously that bought Bitcoin post election, right, and
Mhm.
saw those coins appreciate meaningfully as a lot of positive political developments emerged, especially around the U.S. kind of regulatory environment for crypto, but maybe didn't take profits, maybe saw themselves get underwater and now are very eager to get back out at flat, right? That's certainly one dynamic. But there's actually another transition happening that's important to call out, which is the transition of a lot of previously run as companies previously run as Bitcoin miners,
Mhm.
transitioning to high performance compute. And that has also come with a de-risking of the balance sheet. Generally, some of these companies, most of these companies were holding some Bitcoin exposure on the balance sheet, right? Whether it just came from their natural mining operations or from an accumulation strategy.
Yeah.
And you've seen some of that, right? It's definitely resulted in a net transfer of assets from miners into effectively into DATs, right? And obviously, the largest DAT that's been active in the market is Sailors. And yeah, I think that's the other thing to really call out. There has been that persistent kind of offer on Bitcoin. The
Yeah.
other thing that we would note on the desk, I think, just from a derivatives perspective, right? Bitcoin
Mhm.
vol is actually very cheap at the moment, or,
Yeah.
it's optically quite cheap. If you look at measures of longer dated volatility, we're trading in the sub 50 vol range, which historically has not happened for quite some time. And I think that is also a reflection of just a lack of conviction in holding Bitcoin, up much further beyond here, right? There is actually a lot of overriding happening in the market and
Mhm.
not a lot of buyers coming in to pick up those options.
Yeah. Again, a lot to unpack there. So just one. I don't know if you have these numbers off the top of your head. If you don't, I don't either. But we can include them in show notes for people who want to learn. But can you maybe sort of just quantify the selling pressure coming from these Bitcoin miners? I saw a report. I forget who put it out, saying that this is the first year. I think almost like 70% of mining revenue is going to come from HPC as opposed to Bitcoin mining, and many companies are. I mean, Mara, I mean, the big ones, small ones, they're all, if they're not getting out of Bitcoin mining in their entirety, they are selling down a lot so they can build out for these massive HPC contracts that they are consuming. I know Sailor, you mentioned sort of the runaway success of Stretch. I think they had raised like another billion plus or something last week. I mean, so he is absorbing all the Bitcoin that's being created, plus I guess some of the sell pressure that's coming from these retail investors or these DATs. So I don't know if you can sort of talk about when that overhang from the miners might end. But I think maybe if you are able to kind of just quantify that a little bit for some of the listeners, that would be helpful.
Yeah, I think, I don't have much more to share beyond just like what's publicly available in public filings. But yeah, if you look through the numbers and you look at what is being sold, it's on the order of single digit billions
Yeah.
across all of the public miners. And if you look at what Sailor's buying, it's kind of roughly the same amount, right? It's basically, like you said, $1 billion a week type of flows. So that is actually what is driving this range bound dynamic, if you think about it, right?
Yeah.
There's an offer that's working above a certain price, and then there's a bid willing to come in when there's a sell off, and it's really keeping us trading in a very tight range. That's why I think you do get some moves that come when liquidity pauses. And why is that happening? It's really because like large headlines are hitting the tape, right? So
Yeah.
big sort of geopolitical news hits, everyone kind of widens out a little bit, and maybe some of these programs that we're actively buying or selling also pause. And I
Yeah.
think that's what's driving these like large kind of 5% gap moves, let's say, and then you get sort of a reversion back into the middle of the range.
And I guess just from like a systemic point of view, I mean, I don't know precisely when. Actually, we had a guest on, John Todaro, a few weeks ago from Needham. We walked through all of this, like the minor capitulation economics and the transitions and all of that type of stuff. I mean, I don't know when perhaps that selling pressure will abate, but when it does, I mean, as you mentioned, like that's a big overhang on the price, and you would imagine that if seller's going to keep doing what he's doing, others all of a sudden there's a lot more bid for a lot fewer Bitcoin out there in the market. So that is interesting to watch. I want to focus a little more on derivatives because you started discussing that in your previous answer too. One of the trends that I've been seeing is that this is in many ways spot driven, either through like some of the ETF inflows, or then again, I mean, it could be tax refunds for Bitcoin, some other alts. But if you look at the big run ups in the spot price, but as you mentioned, vol is very cheap right now. Longer dated vol is actually much higher than shorter dated vol, which is sort of the inverse of how things are supposed to go. And funding rates are negative, which all that suggests that there is still some bearish positioning in the market, especially among the smart traders. So maybe you could expand a little more on what you're seeing and sort of how you reconcile, I guess, some of this growing spot demand with a lot of institutions and professional traders that I guess don't seem convinced that the market is really ready to surge again.
Yeah, well, let's unpack that a little bit, right? So I think on the vol side, what you're seeing in Bitcoin specifically is an oversupply of overwriting and basically like yield generation. So you do see a bunch of overhang in upside strikes, like basically call options. People are selling those and willing to monetize them as the price of Bitcoin goes higher. They're selling more Bitcoin against those call options, right? So I do think that dynamic is driving, and the lower realized vol is driving some compression in the back end of the curve as well. That's why it's like historically at a low level. But at the same time, there's only so much lower that December vol, let's say in Bitcoin, can go, right, in the high 40s. You have to remember there's going to be a very large, probably historic midterm election happening later this year. And there is a bit of a steepness in the curve. Like you said, the back is higher than the middle of the curve because of the risk of some large event that could have a meaningful impact on the whole crypto industry, right, in the later half of the year. So I do think that's like a phenomenon. We'll have to see how it plays out. And historically, that has realized, like, the summer months usually tend to have a lower volatility. And then, going into an election year, you have a large event in Q4 effectively, right? So yeah, that's something to watch. I would say the other points that you made around basis and the funding rates, I think that's actually interesting. Like, we have to remember how funding rates are calculated. Actually, it's the difference between perpetual swaps and spot. And if you think about what is actually being purchased in the market today, it's actually all being funded by cash, right, up front. And it's all being funded by cash from Strategy's sale of Stretch preferred shares. So if spot is what is being purchased, then obviously spot is going to lead the market higher. And so you have a dynamic where perps are actually lagging, like fewer people are actually taking leverage to go long Bitcoin. So that's actually a kind of a healthy phenomenon, right? That it's spot leading the move, and it's fresh cash coming into the market. So I am actually optimistic. Like, that's a good sign, rather than something that should be taken negatively.
Just two more quick ones, and then we'll take a brief pause. One, this type of setup and sort of the divergence between what we're seeing in spot versus the sort of like the neutral to perhaps slightly bearish setup in derivatives. Are there any historical precedents in crypto's recent history that ring familiar?
I think so. I mean, it all feels to me, crypto is the most cyclical asset class in the world, right? So it feels a little bit like the post 22 crash environment, where a lot of folks were still getting their bearings again and kind of rebuilding balance sheets and things like that. And that resulted in a historically low implied vol environment. Like, maybe some of your listeners will recall, there was a very persistent offer on Ethereum. There's like a large Ethereum overriding program that was like actually the biggest phenomenon in liquid markets in that time period in like 2023. but yeah, that's kind of the environment we're in today, right? I would say less so on ETH. I think more on Bitcoin, perhaps also on Sol. But I think there's sort of a lack of conviction, or maybe just more of a conviction that we'll be in a range bound market for at least the immediate future until we get more, perhaps more clarity on the Clarity Act, and also more clarity on what happens in the midterms.
I tell you what, we're going to have a big problem if the Clarity Act ends up passing into law something other than the Clarity Act. Although I guess maybe it'll be easier, so we don't have to keep apologizing for using the word clarity twice in a sentence. All right, we're going to turn to alts and a couple of other topics in a brief moment. But before we do, let's take a pause so we can hear from some of the other sponsors who make the show possible.
Bitcoin changed how money works. Citrea changes how Bitcoin scales. Citrea uses Bitcoin as both the settlement and data availability layer. As Bitcoin's application layer, Citrea enables the first trust-minimized BTC on a fully programmable platform and a native stablecoin for Bitcoin, ctUSD. Citrea offers Bitcoin capital markets with lending, privacy, payments, Bitcoin yield, trading, and predictions. Citrea expands Bitcoin's utility without sacrificing its security. Citrea mainnet is live. Get started at citrea.xyz/unchained. MultiChain Advisors is an emerging technology growth firm that has helped create over $50 billion in enterprise value for more than 80 clients, like Pith, MoonPay Commerce, and Wormhole. They've worked with some of the largest and most impactful companies in the space. They're the partner you want when you're navigating markets and trying to break out from the noise. They help navigate TGEs, go-to-market, BD, and partnerships, capital markets advisory, PR, media placements, KOL activations, and more, driving execution from launch to scale. Their results are measurable. To learn more and start building real traction today, visit multichainadv.com. If you've been loving Bits and Bibs, don't forget that the show is transitioning to its own feeds on X, YouTube, and your favorite podcast player. If you're not already subscribed to Bits and Bibs on its own channels, go there now and hit that subscribe button so you can keep up with our twice-weekly live streams and Macro Meets Crypto breakdowns. Bits and Bibs will only be on the Unchained feed for a few more weeks, so subscribe today to be ready for launch. You can get all the links at unchainedcrypto.com/bitsandbibs.
All right, welcome back, everyone. We're talking with Josh Lim, co-global head of markets at FalconX. I'm never going to try and say your title again. I've already messed it up twice. Anyway, we spent the first part of the discussion covering like what's happening with Bitcoin and how traders are aligning from a macro perspective, given this sort of tenuous peace deal or pause in the fighting between Iran and the U.S. and Israel. I want to expand the conversation a little bit now to focus on alts. You mentioned a couple, Josh, that have been doing well, but to begin, I'd like to begin with ETH. It's typically when Bitcoin rallies, it sort of brings the whole market up behind it, and then the market surges past it once we rotate into an alt season. This time, it does seem a little bit different, though. Bitcoin has been grabbing headlines for finally sort of fulfilling its prophecy as digital gold or the store of value, but close watchers of crypto will know that ETH and even like I think BNB and some of the other major alts have been outperforming Bitcoin. And I know like ETH has outperformed Bitcoin, I think somewhere like 5 or 8% or something over the last month or so, which to me at least is unusual in tenuous environments where crypto is looking to find its footing. So I'd really love to kind of get your sense on what's happening. What do you see on your desk?
Yeah, sure. I do think ETH is coming out of a period where there was a little bit of a hangover from the voracious dad buying last year, right? And that did create a lot of new narratives around Ethereum. Ethereum is a substrate for stablecoins in particular. That was like a very popular TradFi narrative around ETH and how it ultimately accrues value. I think what's actually happening now is that ETH is like recovering from that hangover in a very different way. And I think the different way is it's sort of like a counter positioning itself versus Solana. And it's sort of getting its groove back in a way, right? Like Solana has had such a tremendous run in the last couple of years, especially post the issues that it had around FTX. It gained a lot of traction again as a platform for meme coins and for speculation. There were
what did it drop down to? It dropped down to like low single digits, right? Or I mean,
yeah, exactly. Definitely in the teens. But yeah, and then it went all the way back to 200, above 200, right? So I think what we're seeing is just a little bit of give back there, right? And then those inflows are coming into Ethereum. That's kind of what we're seeing on our trading desk. And the question is why, right? I think the reason is you have some of the narrative starting to fade around Solana, and that is coming through on some of the speculative applications that are building on there, and the kind of like lack of maybe retail participation in crypto today, and some of that retail capital is obviously migrated to stocks, or even if it stays on chain, it's probably more in RWAs and tokenized equities and HIP3 perps, things like that. But there's still a persistent sort of undercurrent of DeFi happening on ETH, right? Always. ETH you can always count on ETH as being like a reasonable place to deploy new protocols, new RWA tokens. And we ourselves have a token that we launched on Ethereum that is a tokenization of a portion of our balance sheet. And that's actually gained some good traction because it's proximate to things like Morpho and looping strategies there. So, I think that's kind of what we're seeing is like a little bit of that narrative that's always been there for Ethereum kind of get a new resurgence. And then you kind of see some of the narratives that were driving Solana's huge run up start to fade away a little bit. Now, I will say oh yeah, go ahead.
I was just gonna to add on. I'm just curious how you're seeing Solana trading behavior, like how usage of the network is, I guess, recovering or remaining resilient after the drift hack.
Yeah, I think there's always going to be staunch supporters of this network, and there is always like a strong cohort of builders building on it, right? And I think the one thing that Solana's got to refocus on, I think they've done a decent job of kind of refocusing on this now, is being that stablecoin transport layer. And I think, there were actually very strong signs of that adoption post some of the turbulence last year, October of last year. Solana was actually very, very reliable as a means of transferring USDC collateral across venues. And the people who were able to move it on Solana and had, stablecoins on Solana benefited enormously in terms of meeting margin calls and things like that in a way that was difficult with Bitcoin, right? Or even ETH with some of the network congestion. So there's clearly some advantages there. I think some of the narrative and mindshare has gone to things like Hype and to Canton, right? Like I think you probably were around for Digital Asset Summit a couple of weeks ago in New York, which was largely dominated by banks and asset managers. And
I was around for those summits back in 2015, 2016 when R3 and Hyperledger and Digital Asset first launched.
That's right. Yeah, it's 2.0. But this
is my third permission blockchain cycle, I have to say.
That's right. But that narrative is stronger than ever, but it's happening on new chains, right? So I think that's sort of something that we have to keep in mind, is there are new entrants that are trying to gain market share away from existing players.
Yeah, and that kind of fits into a question that I've been wrestling with too for a while. Like people are going to wonder, when's the new alt season going to happen? It won't necessarily have the same fingerprint as previous ones, because as you said, there are new places for especially retail to speculate. There's we didn't mention prediction markets, but that's a big one. And then nowadays, I mean, just looking at the volume that Hyperliquid is doing, like in terms of like gold and especially some of the oil contracts, I mean, that volatility is absolutely massive. And many alts, I mean, they'll run up and then they'll go down and then they'll stay there. So I can certainly understand, like, retail traders that have gone through at least one or two of these alt cycles, maybe they want to try something new. You guys, I am sure, are tracking all of this. So maybe just as a way to move the conversation along a little bit, How have you seen traders on your platform leverage things like perps in traditional commodities on Hyperliquid or some of the other platforms? And to the extent that you can share, I'd love to understand like what types of strategies are. There was a really interesting article in Bloomberg a day or two ago about some new market neutral strategies that are leveraging price disparities across platforms and things like gold and copper. And there might even be a bit more of a basis trade in commodities than there is in crypto because it's so compressed. So how are you seeing traders on your platform use Hyperliquid and some of these more like tokenized stocks or tokenized commodities?
Yeah, absolutely. And, this is something that is a bit of a hallmark of Hyperliquid, that it is transparent and on-chain. So you can actually trace, activities of large trading counterparties on-chain, for better or worse, right? And I think that is something that gives people some comfort because it's transparent and you can control risk that way, like by understanding how much leverage is in the system and how much the risk of liquidation there is. But at the same time, it's also resulting in situations where, it's very visible when someone puts on a large trade and the market can kind of hunt it down, right? So I would say this, look, there is enormous demand on our side from our client base to access Hyperliquid and other on-chain venues to trade RWA assets 24/7. That's like undeniable. That is a real value add for Hyperliquid. I mean, even not just crypto degens trading, but even TradFi institutions are taking cues off these weekend markets to figure out where things will trade on Monday, right? So I think that's true. I think we've seen actually inflows. We were one of the first prime broker platforms to enable Hyperliquid access to our DMA clients, and also to empower them to cross-margin that across centralized exchanges like Binance, and utilize margin financing across those venues. And I think that has actually fueled a lot of these types of arbitrages that you mentioned. There are disparities between people who can only access DeFi venues and people who can only touch centralized exchanges. And that's causing sometimes momentary dislocations, sometimes more extended dislocations and funding spreads. I think the article that you mentioned highlighted one that the strategies that are effectively trading the roll. And this is obviously very common in traditional markets where you have commodities indices that have to transfer some of their portfolio, their basket, their reference basket from front month to later months as those front months expire. And we're starting to see people start to implement those types of strategies on the Hyperliquid perps that reference these types of rolling indices. So I think there's only going to be more of that. Not only is it going to be used as this price discovery tool, but there's ample arbitrage opportunities for sophisticated traders and investors who have been running these strategies, by the way, in TradFi for decades, right?
So do you think, I'm sorry to interrupt. I'm just want to tie a bow on this. So do you think like alt seasons in the past are are we going to see similar types of alt seasons again? Or in this new world where everything is commoditized, everything is tokenized and potentially available to trade 24/7, liquidity is going to go there, and maybe crypto focus is really going to be on some of those blue chip assets, those blue chip platforms that have more legitimate use and are not purely tools of speculation?
I think it's basically the token market that has to catch up to where equities are, right? And I think with Clarity Act and with other legislation that's going to create a path for tokens to become securities, that is actually kind of the long-term future for altcoins. That could be sad news to hear for some of us who've been in the space for many years and view tokens as this novel sort of capital formation tool and speculative tool. But that's kind of where the market has to go, right? Like there's already just a broad concept, the concentration of mind share and capital into a select handful of tokens that are linked to revenue generating protocols is already happening, right? We all know that, if you're a new, liquid fund manager and you're not holding hype, like that's, you're out of consensus for sure, right? So I think that's only going to keep happening, and and that is sort of the unfortunate reality, is like a lot of the tokenomic models for altcoins in the last few cycles are not really conducive to positive returns on the tokens themselves, right? They're highly inflationary and things like that. So this is the ultimate backlash against that, is now people want to hold equities that, generally have a positive drift rather than something that has a negative drift.
See, it's funny. I mean, I understand sort of the sense of nostalgia and perhaps like a bit of a melancholy tone for what you're saying here. But I mean, this, and people have watched or listened to me for years know, I mean, I spent years at Forbes and at Unchained trying to point out altcoins and zombie coins and tokens that really had no business ever existing except to offer someone potentially a liquidity event. So like, I understand speculation does not have to be a 4-letter term, but speculation and capital formation are very different buckets for me, and maybe just a little bit of speculation belongs in one. So, right. It is, So I understand the sense of nostalgia that I'm sure a lot of people will feel. But if this is more firmer footing for crypto to really grow, we'll all benefit. All right, we have about 5 minutes left, but I wanted to save a little bit of time because you put out a really interesting post on sort of the quantum threat. As it relates, in particular to Bitcoin, but as we've discussed and on the show and people have seen everywhere, the risk it might vary to certain degrees based on blockchains, but it is something that all major chains is going to have to deal with. And I thought did a really nice job of kind of encapsulating the problem as you see it, and in particular, you pointed out how it's not just like a technological issue, but it's also sort of like a communal issue, because the tech solutions, it's easy to see a path forward, but I think if I'm characterizing your post or your thread correctly, Bitcoin, by its very definition, is kind of remains in stasis. It's hard coded, and that's its value proposition. So when you have to do big things, it can be difficult. I mean, I think you referenced the block size wars and the hard forks from like 2016, 2017 when Bitcoin Cash was created. I mean, I lived through all of that and had no idea how it was going to go. And that seemed to kind of have a bit of a happy solution because everybody got extra coins. And if you didn't like Bitcoin Cash, you could just sell it and get rid of it and thank you for the extra money and go buy more Bitcoin. But I think the case you make is that in this situation, it may not be that simple. So with that very long run up, please share your thoughts.
Yeah. I think this isn't an easy topic, right? It requires a lot of specialized knowledge. But what I wanted to highlight in my thread is just how these things will impact tradable markets for those of us who touch the liquid asset class every day. And I didn't see like a lot of discussion around this previously, right? I think the general dismissal of the quantum concerns are like, it's actually very easy for the community to reach a consensus and migrate to post-quantum signature schemes and those types of new cryptography that are quantum resistant. And that's, of course, entirely true. But like you said, and I mentioned in the thread, it's not just a math problem. It's a social consensus and political and governance problem too, right? There's like a fundamental ethos of Bitcoin around it being immutable and around it being sovereign, and the fact that you're holding your coins means that no one can take that away from you or change its fraction of the network. And the fundamental thing here that has to happen with the Satoshi coins and other sort of coins that are held in P2 pay to public key addresses is that those coins, unless someone is actively controlling them today, are going to basically always be vulnerable because anyone could come in and crack the private key. So I think it's sort of not a solvable problem except by social consensus, and even that will probably result in some sort of hard fork. If you assume that there is still some sort of core community that believes in the initial sort of ideological roots of Bitcoin. Maybe not, right? Like it's possible that a lot of those people have moved on to other crypto assets, other crypto projects. And it's possible that the majority of holders in the space now are are institutional investors, right? And
Yeah.
it's true, right? It's a lot of the assets are being held in ETFs. But
Yeah,
if you think that there will be a schism, I kind of do think that there's going to be some very staunch resistance to it, that that will be negative for the price of Bitcoin, and then you have all sorts of implications for the derivative markets on top of that.
Yeah, it's a really fascinating debate because, I mean, the whole mantra "code is law." That should theoretically, I guess, from my opinion, mean that if code is law, if someone's able to crack Satoshi's private keys, finders keepers, I guess. It almost like harkens, but even if like morally that may not seem right. It reminds me a lot of kind of the debate within Ethereum surrounding the DAO hack and sort of like what to do there. And anyone, I mean, most people watching and listening to this will know what happened, but it was not amicable at all, and it led to a split in the chain. That I mean, Ethereum managed the version that essentially rolled back history, returned the tokens to the original holders, maintained its status as the dominant chain, and Ethereum Classic hasn't really sort of built up to be a real competitor. But it was very it was a very antagonistic time there, and I remember like we weren't sure what was going to happen. So it is really a fascinating setup to see what's going to happen with Satoshi's coins. Maybe it'll force him, her, or they to come out of hiding and do something so that that those 1.1 million Bitcoin don't all of a sudden become liquid or get hacked or whatever. Because as you mentioned, it could have an impact on the price if suddenly all those tokens become liquid and someone just decides to dump it on the market. There's a lot that we don't know. So I guess to just tie a bow on this, are you seeing any noticeable behavior among traders on your platform to sort of de-risk themselves from this? I know in one of the Google papers that was cited, I believe they mentioned Algorand as one of the blockchains that, I'm not a computer scientist by any stretch of the imagination, but had apparently made itself quantum resistant or quantum upgradable. Like, are you seeing any discrete movement into or away from certain tokens because of this quantum threat?
Yeah, I think a lot of the trading happening right now is rotational. It's really like traders trying to move away from things that may be perceived as vulnerable and to other chains that are designed or marketed as quantum resistant. Now, like the reality of it is like the technology is still up for debate. Like even people cite Ethereum as kind of a forward-thinking chain when it comes to quantum migration, but there are still actually probably more vulnerabilities in the smart contracts, the thousands of smart contracts that exist on chain versus Bitcoin's the elliptic curve problem for Bitcoin. But that is it's kind of glossed over, right? Because people say like, hey, there's more of a social consensus element within Ethereum that enables them to move faster and change quicker. So I think, I think that's kind of the what we're seeing, the flows. Now, I called out a couple of things that you would want to watch for, and I don't think those have meaningfully shown like red flags yet. But there are things you want to watch for. Like you want to watch for the differential between traditional markets downside protection versus crypto native downside protection, right? At this point, like most of us who trade crypto traffic in crypto native venues, right? Whether it's like purely on-chain venues like Hyperliquid and Deribit, Hyperliquid and like Uniswap, or centralized exchanges like Deribit, Binance. There's going to be more of a divergence, in my view, between those and the traditional markets like the IBITs and the CMEs and even the bilateral trading that happens between banks and hedge funds. That will reflect a different market than what's happening in crypto as we get closer to the Q day, which is when quantum computers become relevant. Because when you're hedging your exposure, you're going to want to hedge away from crypto. You're going to want to face counterparties and institutions that are not entirely founded and heavy concentration in crypto. So that's what I'm watching for the most, is those types of signals.
Great. All right, well, we're gonna have to leave it there. Josh, as always, thanks for joining. Always enjoy our conversations. Thank you to everybody for watching and listening to this episode of Bits and Bips, the interview. That's it for us, but stay right there because in a few minutes, Laura will be chatting on Unchained with Nader Al-Naji about his SEC and DOJ cases, how they both got dismissed, and why the way they dismissed is so significant. So stick around.